Well, hello everyone, and hope you're all having a great Wednesday. My name is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. Good to see everyone here. To tell me that you can hear my voice and see the screen, just give me a Y or a yes in the questions area. That will let me know that all the technology is working, and maybe also tell me where you are watching from. That's always nice to hear about. Tonight we've got a great event, and this questions area is where you can ask our speaker questions. And we encourage questions. No such thing as a bad question. So definitely participate and ask any questions that you might have. Well, hello, Anise. Good to see you from Dubai. How exciting to have you from around the world. And we've got Mark and Ron and David and all kinds of folks. So thanks for chiming in. Tonight we're doing a presentation entitled Trade Size Really Does Matter, all about risk control, which is so important. And Bennett McDowell will be presenting, and Bennett is an expert in technical analysis, money management, Elliott wave techniques, and more. And Bennett, without further ado, I will turn it over to you.
All right, Jean, thank you so much. Great to be here. Welcome everybody to this afternoon's presentation. All right, so as Jean said, we're going to talk about risk control and the entitlement. Trade size really does matter because we're going to focus on how to calculate your trade size, which is also known in the industry as your position size. So that's going to be some things we're going to show you the formulas and go over that today. I want to invite everybody to our website at traderscoach.com. We're constantly adding content to the website, so definitely check it out. We've got software trading tools, we've got books, we have online educational content, so pretty much specific to active traders. A little bit about the risks involved in trading. It is possible to lose some or all your money trading the financial market, especially if you don't use risk control. But we deal in a realm of probabilities, not certainties when we trade the financial market. So risk is always an issue to control for us. And it's important you know how to do that. Also, it's important that you trade with money you can afford to trade with, called risk capital. And that's even true if you're investing as well. And then finally, we're going to share a lot of ideas with you today, but it's a good idea to run those by your financial advisor or whoever manages your money, just to be sure they apply to you and they're suitable for you, because everybody's situation is different and we don't know your personal situation, and of course they do, so run things by them. All right, new book out. We've got the Money Management for Traders. So this is kind of important and very appropriate for today's content. There's the book right there, and we've got a hardcover book and a softcover book as well. So there's also Kindle, and then there's an audio edition coming out. The great thing about this book is you're going to see some of the concepts. We're going to cover just a few in this webinar, but that book has them all in there, and it's a very inexpensive book. Jean's going to put the link for you, and she has already in the chat area. So check that out on Amazon and order your copy today. I've got some other books available as well on there, so you can check those out. Again, dealing at all different forms of technical analysis. So go ahead and browse those as well. But our new book, Money Management for Traders, just came out. All right, so question I want to ask everybody, why? Why do we need risk control and money management? I think it's kind of obvious, but think about that for a minute. Some people, I've given these webinars in front of hundreds of people at various expos, trading expos, and I've always encountered a couple people that say, I don't use stops, I don't do it, and I haven't really kept in contact with them, but I wonder if they're still in business. If you don't use risk control, it's going to be difficult for you to make a living at this market, and it's going to be even more difficult for you to be around 6 months from now. So I think risk control is very important. I see by a lot of the comments coming in that you certainly agree as well. All right, certainly a fact of trading the markets is that there's some losing trades that really are a normal part of trading. There's no system out there that I am aware of that has a 100% accuracy rate. So you always have to be prepared to cut those losing trades quickly and use risk control. So you need to use stops, you need to calculate your trade size or position size. So therefore, when you do get stopped out, you get stopped out with an amount of risk that you chose to take actually before taking the trade. So cut those losing trades quickly, let those winners run, grasp and hug the fact that some losing trades are a normal part of trading. It's not you, it's not your system. It's just going to happen no matter how good the system is. And of course, as long as your system has a winning edge, we're going to talk about that in a little bit, you're in good shape. All right, so your goal is to keep your losing trades small, like I said before, and let your winning trades run. And the only way you can do that is to have a form of risk control incorporated into your trading rules. How many people out there have a very systematic approach to keeping their losses small? Okay, good, quite a few. I'm looking up at the chat area here. Good, quite a few, excellent. Some say not so much. Okay, well, you're gonna learn how to do that here. So that's a good thing. All right, let's move on here. All right, so I want to cover a couple things here on calculating your trade size. You want to do this for any time you enter a position, even when you're adding in to a trade. A lot of times I'll go in and then add in again when the trend is proven, and I always calculate my trade size every time. And also too, I take a look at the percent risk I want to take. That's really important as well, because that is part of the calculation to achieve your trade size. So money management, what does it do? Well, it allows you and acknowledges that not every trade is going to be a winner, so you're allowed to be wrong, helps control that risk, takes into account that every trade can be a potential loss. You know, when we enter the trade, we're very optimistic that the trade is going to work out, but we're also very realistic in realizing that we don't always win. And this type of attitude really separates the pros from the novices, because a lot of times when people enter the market, they really don't understand what the risks are. And so they're not calculating their trade size. They're not really having their stops at the right place. A lot of people will put their stops at areas in the market based on what they're comfortable with and not based on actual price activity in the market, which really has a good meaning of where you should put your stops. So things like that do make a difference. So it really is a state of mind. And a good way of looking at risk control is if we go to Las Vegas. Think about all the casinos there. Now, all the casinos, for the most part, if they're profitable, basically have an edge over the average player. So they're known as the house. So the house knows that if they play enough games of poker, blackjack, whatever, that they are going to be a net winner after a certain number of plays. That's how you want to look and prepare yourself for trading, because they also know that they can't really tell what particular game they're going to win or lose at the table. Just like us as traders, we don't know what trade is actually going to turn out to be a winner or not. So that's a good analogy. And so every time you think about trading and you think about structuring your risk control, always remember that analogy and put yourself as the house in Vegas, okay? I think that'll help you a lot. All right, now we're going to talk to you a little bit about how much to risk on each trade, calculating the trade risk, calculating the trade size, also known as position size, risk of ruin we're going to talk a lot about, and the actual stop loss placement. Now, you don't have to respond here, but I want you to think at home about this slide here, and I'm going to read it. What causes traders not to use money management and risk control? Think about that. Why wouldn't you use it? If it ultimately is something that's good for you, why would you just ignore it? There has to be a reason. Okay, and hopefully you're not ignoring it, but some people do. And then I want you to think of an experience where you suffered an excessive loss because you did not use risk control. I think we all have them. I have mine, especially early on in my trading. Okay, then I want you to ask yourself why you didn't use money management or risk control. And then what did it feel like? What did that experience feel like? I've done a lot of coaching with students literally around the world since probably 1998, I'm going to say. And it's very interesting because I always ask them, a question around this topic. And it's very interesting because when they've had a real large loss, it really hits home, not only in the pocketbook, but emotionally too. And then you start to spiral. So you got to get yourself out of that spiral. And hopefully that hasn't happened to you. And if it hasn't, that's a good thing. And hopefully this one webinar will keep that from happening, because it's going to talk to you about the importance of implementing a good risk control strategy. So really, when we talk about money management, I think it's important to realize that healthy money management psychology begins when you realize that each trade's outcome is really unknown. Now, again, remember when I talked about we deal in a realm of probabilities, and we do, but we don't know which particular trade is going to be a winner or a loser. We just don't. We're optimistic on taking the trade, but we also protect that possibility of it being at a loss with risk control. So when you start to look at the markets from that standpoint, that changes your whole mindset to a point where you will never trade without risk control again. So profitable money management occurs when you truly believe that you need it. And a lot of people just starting out in the markets don't really know they need it until they have that big loss. How many people out here have had a big loss, especially in the beginning of their career? Yeah, okay, quite a few. Doesn't feel good, does it? But it does teach you a lesson. So the lesson, of course, is that you don't want that to happen again, right? Absolutely. All right, so I want to talk to you about a couple different types of risk. There's something called trade risk versus market risk, rather. Does anybody know what the difference is between trade risk and market risk? Give you a minute to answer here. Some of you have got it already because you've been, I think, on this webinar before. All right, so let me just go over it, okay? So trade risk is something actually that we can control in the markets. Market risk is something that really is out of our control. All risk to some degree is a little bit out of our control. But when we talk about trade risk, we're talking about the amount of risk that we're going to take on that trade if the trade gets stopped out. Market risk is unforeseeable events that can happen where our trade risk does not protect us like we think it should. What would be an example of that? Well, let's say you're trading the financial markets, you carefully calculated your position size, you've got your stop in place, then all of a sudden, some catastrophe happened and caused the market to drop down way below your carefully chosen stop, kind of like a gap. So you end up getting filled at not the price you wanted to, but at a lower price. And you always want to have a stop with a stop market. Don't use a stop limit, because you want to get out of that market if it hits that stop. But the market risk situations can cause those carefully chosen parameters of risk control to not work at that time for that one trade. So how do you protect yourself with that? The only way to protect yourself with that is trade with money you can afford to trade with. And this is why wealthy people, wealthy traders, don't trade with all their money. They trade with a percentage of their net worth, because they understand that a market risk event could happen. Okay, it can happen. Let's say your internet goes down, or your phones go down, you can't get a hold of your broker, and you have an open position out there. Okay, so things happen. Okay, that's kind of in the realm of market risk, so to speak. So the nice thing about using risk control is that if you constantly are calculating for your trade risk, then if a market risk happens, it's going to be a lot less devastating than if you didn't use any risk control at all. So usually you can come back from a market risk event if you're using risk control. But if you're not using risk control, it can literally wipe your account out. So that's the difference, a setback versus a catastrophe. So trade size is one of the ways that we actually control our trade risk. So if we know where our entry is, we know where our stop is, then how much we're going to lose if we get stopped out is totally controlled by how many shares or contracts we have in the position. The more shares you have, the larger the actual loss is going to be, right? Same thing with contracts. The account size is how we control the market risk. So you only want to trade with a certain percentage of your net worth. So that's how we control those two facets of risk in the markets. And it's really important you understand that. The next thing I want to talk about is the risk of ruin. How many out there know or think they know what the risk of ruin is? I'll give you a minute out there to think about that. Our goal here is to make risk of ruin work for us instead of against us. And I've got some examples to talk about that in a minute. All right, so we do this by determining the proper trade size or position size, risk percentage based on the risk of ruin tables. So we're going to take a look at those in just a minute. Before we do, I want to talk a little bit about two of the most important aspects you always really should know about your own trading at all times. And they are important elements of the risk of ruin. One is called the win ratio, also known as the win percentage. And it's basically how many trades do you win versus how many trades do you lose. So if you're winning roughly 6 out of 10 trades, then your win ratio or win percentage at that point is going to be 60 or 60%. Your payoff ratio is how many dollars do you make for every dollar you lose. So if you're winning twice as much in terms of dollars than you're giving back, then you're controlling your losses, and your payoff ratio is going to be 2 to 1 in your favor, and that's good. So think about it. If you had a system that's winning 60% of the time, and your average wins are twice as great as your average losses, you're going to do okay. Let's explore that a little bit more. So here's a quick little formula that you can write down. Very simple. The win percentage or win ratio is the number of wins simply divided by the total trades. And there's our example of 60 out of 100, or I said 6 out of 10, but 60 out of 100 would be 60% as well. Now your payoff formula is going to be your average winning trades divided by your average losing trades. And that is usually expressed in a ratio, not a percentage. So it's usually, for example, 300 divided, you had $300 of winning trades divided by the average of $100 of losing trades, then your win to ratio would be 3 to 1. Now here's a chapter out of my book called the Risk of Ruin Table. And you can certainly see on this particular table that if you have a win ratio of 55%, so in other words, you're winning 5.5 trades or winning 5.5 out of 10. Your payoff ratio is 2 to 1. You're going to have a 0.2% chance of going bust. So pretty low. If your payoff ratio is 1 to 1 and your win ratio drops below 50%, then you have a 100% chance of going bust. So you always want to work on getting your win ratio and your percentages of wins, which is your percentages of wins, and your payoff ratio in a situation where it's very difficult for you to go bust. And I usually find if you can win anywhere from 60% of the time with a win, with a payoff ratio above 1 to 1, preferably 2 to 1 or even 3 to 1, if possible, then you're going to be a very, very successful trader. And look at how many trades you're actually losing out of 10, 4, which is a lot. So if you told a novice trader you're losing 4 out of 10 trades, they probably think that stinks. But what they really don't realize is how actually that is a very good figure, because that's going to put you in the ballpark of having an edge in the markets. You'll do extremely well. All right, so first thing you want to do is be aware of a couple things. One is risk of ruin is possible if you don't have the right win ratio and payoff ratio. You put the risk of ruin against you. So you want to try to develop a system before trading with live money where you have that edge, winning ratios, and implement this awareness into your money management strategy. So that's why I say if you have an edge in the markets, go ahead and exploit it. But if you don't have an edge in the markets, stay out of the markets until you have an edge. All right, so we can actually calculate and stay within your particular risk parameters on any one trade. All right, we do this by when you actually keep track of your results. For example, let's say you're winning 60% of the time and you have a 2-to-1 ratio. Well, if you look at the tables and look at the formulas, you can actually calculate the percentage amount that you should be losing on each and every trade, because that's going to be a product of those two calculations. And from that, you can determine going forward as well what your trade size should be. So let's take a look at this. Novice traders usually trade the same trade size on every trade. So true. Again, if I go back to my coaching experience, one of the first questions I asked people in their first session was not only about the large losses and how that felt, but also this. I always ask them, how many shares or contracts do you trade when you enter a trade, and does it vary? And you'd be amazed at how many people trade the exact same number of shares or contracts on every trade. Right away, when they tell me that, I know their risk control is a problem, because actually your trade size should change depending on the structure of the trade. In other words, your entry versus your exit. So let's talk a little bit more about that, because trade size really does matter. It is really everything. So we're going to go over a couple examples here that I think will help show you this. All right, so here is our first question, kind of an exercise. If you have a trading account of $50,000 and you are trading with a stock margin account allowing you to margin 50%, this increases your buying power then to $75,000. You trade using 2% risk rule. So in other words, when you get stopped out, you don't lose more than 2% of your actual account size. And that's a calculation you can do based off your win percentage and your payoff ratio. And I'm going to show you that as well. Your trade entry on this example is $26.99 per share. Your initial stop loss is at $25.45. Your commission on this example is $10. So then the question is, what's your maximum trade size? So let's take a look at some of the variables here. First the question is, do we have enough variables to calculate what our trade size should be? In other words, how many shares you're going to enter the trade with, or if you're trading futures, how many contracts? Do we have enough information? Okay, Dave's saying, sure, yes, we do. And you're right, we do. All right, so we know our account size. Our cash account size is 50,000. We know we're trading with a 2% risk rule. We know our entries at $26.99, and we know our stop loss is at $25.45. Why do we worry about commission? What does commission have to do with this? Why is it in the example? Because your commission, if you lose on a trade, will add to your loss, right? So you have to make a slot in your calculations to include that. All right, so then the question is, what's your maximum trade size? 500 shares, 750, 642, 295. Well, I'm going to show you how to calculate that. The first part of the formula we're going to look at in this exercise is to calculate your dollar risk amount. Now we know we're at 2%. That was given. So you can't have an easier calculation than this. Step one, 50,000 times 2% is 1,000. So we want to make sure that if we get stopped out, we're not losing more than $1,000. Now, does that mean you can only buy $1,000 worth of the stock? And the answer is no. It just means if you get stopped out of that stock, that you're only going to lose $1,000. Big difference, okay? So don't confuse your dollar amount that you can lose with how much buying power or how much the stock costs to initiate the trade. All right, so that's kind of important. So in our example, we don't want to lose any more than $1,000 bucks. So let's go to the second part of the calculation. You take the risk amount, which is that $1,000, and we have to subtract out the commission because that's all part of the equation on calculating a loss if we get stopped out. All right, and then what we do underneath that, we divide that, okay, by the difference between your entry and your stop. So in our example, all right, $1,000 represents the risk amount of 2% in dollars. $10 represents the commission. We subtract that from the 1,000. That leaves us with $9.90. We divide that by 154, which is the difference between the point difference between the entry and the stop. And when we do the calculations, it gives us the amount of 642 shares. Now, we have a very neat piece of software. We actually have two that does this for us. One's the trade size calculator, and the other one's called the risk to reward calculator, which has the trade size calculator built into it. But since we're talking about trade size, I'm just going to stay on that for now. So here is all the variables of that trade put into the calculator. So here's the count size. Here's the percent risk, the entry price, the exit price, the point value to calibrate the calculator is $1. Now, you know, when we trade futures markets, the point value varies. For example, if you're trading the S&P E-mini, then the point value is going to be $50 because that has 4 ticks in a point, and each tick is valued at $12.50. So the point value helps calibrate the calculator for the particular market you're trading. The commission we put in is 10, the margin we put in at 150, and we hit calculate. Okay, and check this out, 642 shares is what it comes down to. And if we get stopped out, $998 is the amount we're going to lose. So we're allowed to lose up to $1,000 and stay within our risk of ruin table. So this puts it slightly under that because 1 share more would put it over. So in answering the question now, it's pretty easy, 642 shares. So it's not a complicated process, but you do have to understand what you're doing. Let's take another one, okay? So here's another one where we have another $50,000 account. But on this particular question, what we're trying to hit home on this is the fact that how much does it cost to make a trade, even when using risk control. So let's say we're going to go back to our $50,000 trading account. We're going back to the fact that we have a 50% margin on that, $75,000. So you always put the cash value in the calculator, that's 50. All right, you trade using the 2% risk rule. Your entry on this trade was $91.49. Stop loss is at $90.23. Your commission on this one is $51.22. So then the question is, how much is the total cost of your initial trade with a 2% trade size calculated risk? 1,000, 1,500, 68, 891.97, or 18, 891.97. Let's go through the process. We're going to go ahead and bring up the trade size calculator. And we know based on calculations, we put the account here, the risk here, entry, exit, $51.22 commission, everything else, the 1 and the 150 stays the same. And we calculate now, and 753 shares is the maximum amount we can trade. And if we get stopped out at $90.23, we'll lose a full $1,000 bucks, but that's 2% or 50,000. But the real question of the question was, what's the trade going to cost? Well, you take 953 shares times 91.49, and that means the trade cost $68,891.97. So how much margin are we using? Right, $18,891.97. So what this drives home is the fact that even though we're limiting our risk to $1,000, we're still, okay, we still are using buying power at sometimes to actually execute the trade. And the more expensive the trade and the lower the account value, the more you're going to use, to a point where you won't be able to trade until you start closing that trade out. So the nice thing about this is it keeps you from over trading. And the reason why we ask your buying power is because if, for example, the stock got so expensive that we exceeded the $75,000 amount due to buying power, then the trade size is going to be capped immediately at that figure, so you don't use more money than you have. So now that you're kind of understanding a little bit of this, I got another question to ask you. All right, if the distance between your entry and exit is closer than $5.75, then what would your trade size be? So let's take a look at this. Let's say we do the calculations like we're doing here, and the trade size on this example, because this is the S&P E-mini. So here's our $50 in at the point value. Here's our margin. Here's our initial size and price here back in the old days, right? So the amount of contracts is 6. But the question I'm posing at you on this one is, what if we put our stop under this price bar here? And the trade size and the stop was basically right under here, which would be half of where it is now. Would the trade size be larger or smaller? So this price here, whatever one tick under here would be, that would be put in as your exit price. So what do you think? Would the trade size be larger or smaller? Correct. I think everybody's got it. Larger. So when the raw distance between your entry and your exit is closer together, that allows your trade size to increase. Yet if you get stopped out, you're only going to lose $1,000 because your actual risk point or price level for your stop is closer to the entry. So the variable you're solving for is always position size. That's why when you ask a trader if they trade the same number of shares on every trade, then they're probably at that particular point not fully understanding how to calculate their risk control. And the other important part is stops. You know, you just don't want to pick a stop out of thin air in order for you to trade 500 shares. You want to have that at a legitimate place in the market. So if you're stopped out, you want to get out because your analysis is wrong. And so therefore your stop should always be calculated on key levels of support in the market, so you know at what point you need to get out. And at that particular point, that's the stop you used in calculating your trade size. So your risk is in line, okay? So calculate immediate action, okay? I always like to talk about what can you do right after this webinar. So immediate action. You have the tools in front of you right now to calculate your trade size on every trade. And you also can use initial and trailing stops on every trade. That's something you can do right away. And if you need more help in this, get this book. I think it's like 15 bucks or something. So it's not that expensive, but it has all the calculations in it. And it has a lot more of the explanations in there as well. It's a great book. All right. How do you do that? Well, you can use the trade size calculator software. That's inexpensive too. You can use the formulas, okay, that we give you in the book. So it's all there, okay? All there. So by acknowledging the good and the bad of what could happen, and by fine-tuning your money management system, you will be on your way to a greater prosperity. So true. It really changed my life when I first started trading. I've been doing this over 30 years now, And I remember when I first got into the markets, I really didn't have a good handle on risk control. And when I finally learned these concepts, made all the difference in the world. Okay, and so all these concepts are what I basically put in this book. All right, let me just see if there's any questions. Hedging with options, that's a whole different ball game, Mark, okay? I will tell you, if you want to do options, there's two ways of doing that, at least two ways I do it. One is if I calculate, if I'm doing stock options, for example, and it shows me I should be trading with 800 shares of a stock, well, I can just buy 8 contracts of the stock option and make sure that I get out at a point that has meaning both for the option and for the stock. So I don't lose any more than $1,000 in our example. Or if your 2% of your trading account is $1,000, then buy any option you want to, but just don't buy more than $1,000. And that way, if the option expires worthless or you lose, okay, then you can basically only lose $1,000. So you're within that 2% risk. Okay, so you know the key thing is you always want to use risk control and be smart about it. All right, because it is an excellent way, all right, to make a good trading system even much better. All right, I think Gene, we got through excellent questions today. Very good.
Yeah, very nice group. Very good to see you all here. I see a lot of our regulars. Good to see you, William. So I guess then we'll close out for the evening, and great to have everyone here. We hope to see you next Wednesday and every Wednesday for Wednesday Night Live. Have a great night.
All right, good night, everybody. Thank you, Gene.